Good afternoon and welcome to BizTech's Asian Midday Market Watch. Our guest today is Jeffrey Halley, Senior Market Analyst, Asia Pacific at OANDA. Now, Jeff, it's always great to have you on the show.
Cheers. Great to be here, Brian.
Now, Jeff, before we drill down into the turmoil that's happening around the world, let's first take a look at how crypto markets are performing because they bounced back sharply. Bitcoin is at 43,331.3. It's up 14.58%. Ethereum is at 2,918.16. It's up 11.71%. Now we take a look at how regional stock markets are performing. The SGX is at 3,269.9. It's up 0.85%. The KLSE is at 1,602.69. It's down 0.35%. Shanghai is at 3,474.37. It's up 0.35%. The ASX Ordinaries is at 7,386.2. It's up 0.86%. The Nikkei is at 26,926.5. It's up 1.51%. Hang Seng is unchanged at 22,707. And the Kospi is at 2,699.18. It's up 0.84%. Now, what's your view on market performance this morning, Jeff?
Well, we saw a relief rally once again in New York, which unwound most of the losses that we saw in equity markets, in particular earlier in the day across Europe and in US stocks. Although I must say, Asian equity markets were reasonably resilient yesterday. That momentum has carried through into markets today in Asia, and we've seen most stock exchanges across the region post some quite positive results. I think the interplay here is, there was a meeting between Russian and Ukrainian officials on the Belarus border yesterday. They didn't actually agree to anything concrete, which is no surprise, but they did agree to meet again. So that was a positive development in the minds of the market, but also given the scale of the sanctions that we saw enacted by the EU and the US over the weekend, I get the feeling that the markets are now pricing that we're in a peak Ukraine situation and there can't be much more worse to go. And thus we're seeing a relief rally today. How long that lasts, I'm a bit skeptical, but that's the state of play at the moment.
So Jeff, give us some insights into the key things that you've highlighted in your commentary today.
Look, I'm actually saying that although the markets are in a bit of a peak Ukraine moment, we may not have seen the worst of this. I certainly hope we have, but I wouldn't rule out anything on that front. I think it shows just how much money is sitting there desperately looking for a reason to buy the dips in equities at the moment. But we do have a lot of US data coming out this week as well. PMIs, ISM PMIs, ADP employment, and of course, the non-farm payrolls this week as well. Plus, we have 2 days of testimony by Jerome Powell on Capitol Hill starting tomorrow. Now, all of that may come out, a strong set of data and then some hawkish commentary from Jerome Powell could put this whole half-point rise by the Fed at the mid-month FOMC meeting back on the table. And that may nip this equity rally in the bud if it looks like the Fed is suddenly moving to playing catch up on its inflation.
Now, Jeff, I want to move on to commodities because you predicted in the show last week that oil would touch 130. Do you still hold that view?
Not now. I thought that would be the initial shock, and that didn't turn out to be. We got to, I think, about 106, so well short of that target. Look, I think the main reason for that initially was because the initial sanctions after the Russian invasion were designed specifically not to shut down the Russian oil sector. And when we look at the commentary also from US and Europe regarding the closure of SWIFT to Russian banks, there still seems to be a mechanism there whereby payments can continue for oil and gas and other industrial commodities from Russia. It's been notable the lack of detail regarding that SWIFT closure to Russia rather than detail in my mind. And I think that's what's taken the edge off what would have been a huge rally by oil prices if Russia had been completely shut out of that market. Having said that, it's clear that there will be logistical issues financing anything from Russia now, with banks and other financial institutions very scared that they'll be crossing sanctions from the US in particular. It looks like oil's making a bit of a top around 106. And I think we're going to have to see a severe deterioration in the Ukraine situation for that to change, to see new highs on Brent crude. Having said that, I don't really think it's going to fall much more than 96.
Now, Jeff, you touched on something is really in terms of that squeeze on payments related to the clampdown on Russian banks using SWIFT. Would that then be one of the explanation why we've had this surge in prices of Bitcoin as basically payment mechanisms shut, and this payment mechanism obviously is still open?
Well, we know that the banking system will effectively be shut in the Ukraine for obvious reasons, but what we saw over the weekend was a bank run in Russia. The ruble fell by, I think, 30% yesterday with these measures. So the ruble is going to become a very bombed out currency. And I think the ruble's effectively lost about half of its value over the last week. It's extremely inflationary, but if you've got savings in rubles, that's not a very good place to be, because you've just lost half the value of your savings and spending power. And I was expecting this trade to appear actually sooner, but I think it took that blockage or those sanctions, that ratcheting of sanctions over the weekend to drive it home. So I think we're definitely going to see some alternative payment measures now emanating from Eastern Europe, as Eastern European savers or investors or everyday consumers look to move their money into something that's going to hold its value. One of those things will probably be Bitcoin, whether you believe in cryptos or not.
Jeff, as always, thank you very much for your insights, and thank you very much for coming on the show.
A pleasure. Cheers.
Now, we've been speaking to Jeffrey Halley, Senior Market Analyst, Asia Pacific at OANDA on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Please check out this video and podcast on our website, www.biztech.asia, as well as our various social media platforms. Please like and subscribe to them. Thank you very much for tuning in.